From October 2020, Alibaba stock is going down. And there are a number of reasons for that. First of all, there was a worry of delisting from New York Stock Exchange. Actually, it is still a worry, but they are working together, United States and China, to avoid that problem. The other issues concerning Alibaba have to do with US and China economic conflicts. The other problem is COVID and zero tolerance policy in China, and therefore there are a lot of lockdowns. Disappearing of Jack Ma after he said some criticizing words about the Chinese government. There was a stopping of IPO of Ant Group, which is owned by Alibaba. And then there were some fines for monopolistic activities from Alibaba and new taxes for big corporations in China that were put in place recently, and so on, and so on. So there are a lot of headwinds for Alibaba. And in their recent financial results, Alibaba showed that they are actually not doing that great in this new harsh environment. As we can see, income from operations is down 19%. Net income is down 53% and earnings per share are down 48%. So let's see, does this new price actually compensate all the problems that lie ahead of Alibaba? So first of all, let's see, what do we know about investors in Alibaba? Insider buys, we have no information about any insider movements in Alibaba. And what about super investors? That's a check. There are a lot of great super investors invested in Alibaba. Just to name a few, there is Charlie Munger, Guy Spear, Thomas Russo, and there are a lot of other investors that are buying Alibaba in the recent quarter, like ClearBridge Value Trust, Prem Watsa, David Tapper or Bruce Berkowitz. So as we can see, there is a lot of interest in Alibaba. So let's see the fundamentals of this company. First of all, return on invested capital. That's a check. The return on invested capital in the last 10 years was around 13.3%. And we are looking for a return over 10%, so this is really nice. What about free cash flow growth? That's also a check. It is 33.6%. This is quite astonishing because, like with return on invested capital, we are looking for a free cash flow growth of around 10% or higher. This is absolutely incredible. What about shares buyback? That's an X. In the last 10 years, they issued 14% more shares. And actually in the last year, they bought some shares back because of the lower price. So we may see that this trend will keep on going and they will actually buy back some of their shares. What about dividend yield? That's an X. Alibaba doesn't pay any dividends at the moment. And what about the debt of the company? That's a check. It would take them around a year or a year and few months to pay their long-term debt with their free cash flow. But actually, I didn't use for this calculation the last year free cash flow, but the 5-year average one. The reason for that is that last year the free cash flow was very, very low. So I used a 5-year average free cash flow for this calculation because I believe that it actually represents the company better than just the last year one. Okay, so let's value the company with a discounted cash flow formula. For that, we will make some estimates. First, the growth for the first 5 years and then another 5 years. And we will make 3 scenarios. A low one in which we believe that the company will achieve this even with a lot of headwinds. a medium one when we believe that this is what the company most probably will do, and then a high one in which we believe that the company is going to thrive and really do well. Okay, so for the low scenario, first 5 years, 10% growth, and for another 5 years, 5% growth. For the medium scenario, 15% growth in the first 5 years, and then 10%. And for the high scenario, 25% growth and then 20% growth. For the high scenario, it seems very high, but we have to remember that this company still is growing really rapidly. So it is possible that they can keep on growing like that for the next 5 and then 10 years. Okay, so what's the intrinsic value? It's somewhere between $133 per share and $405 per share. But these are not the prices that we should be looking for, because we always have to use a margin of safety. I use a 30% margin of safety, and that allows us to actually be a little bit wrong with our estimates and still make some money, or at least not lose that much money in our investment. So the price with a margin of safety should be somewhere between $93 and $284. And as we can see, the current share price is $95. So we are really close to the price in the low scenario. And the difference between the current price and the high scenario is quite substantial. So it seems like there is a lot to gain with Alibaba. Okay, so is it a buy still with all the troubles that happened and that most probably will happen for Alibaba in the future? It is a tricky situation, because on the one hand it looks really appealing and we can see that there is a lot of potential and a lot of great investors believe that as well. But on the other side, the risks are also very substantial. So tell me in the comments, what do you think? Is Alibaba still a buy with their recent results? Or is it a stock that we should avoid because the risks are too high? But whatever you do, remember to do your own due diligence. Get to know the company better, read their financial reports, and then decide by yourself what to do. Okay, so that's it for today. Thank you very much for watching. I hope you enjoyed it and you found it interesting. And if so, then please like it and subscribe to the channel if you haven't already. Thank you again, and bye-bye.